Is your savings account paying you 4%? Well, DeFi protocols are paying 10, 12, sometimes 15% on the same dollar. Your bank has known this for years. They just don't want you to profit the same way they do. These are 5 finance tips they're counting on you never finding out about. The banking model is simple. They borrow your money at 4%, they lend it at 12%. They keep the spread, you get the scraps. Decentralized finance has built a parallel system that cuts out the middleman entirely. Here's what that looks like in practice. This is Agent Blockchain. Tip 1. Stop parking cash in savings accounts. DeFi protocols like Aave and Compound are offering 8 to 15% APY on stablecoins, assets pegged to the dollar. Near zero volatility exposure. Real yield. Now here's the twist. There are no executives taking bonuses, no margin. The yield is passed directly to you through smart contracts. Your bank cannot say the same. Tip 2. If you already hold stablecoins, they should be working right now. Most investors park USDC or USDT as a safe haven and let them sit, earning nothing. That's cash under a mattress while your neighbor earns 12% down the street. Stablecoin lending protocols pay you passive interest automatically. No lockups, no approval process, no loan officer. The money moves because of math, not because a bank decided you qualify. If this is landing, subscribe. This channel covers exactly this. The intersection of real wealth, blockchain, and what traditional finance isn't telling you. Tip 3. Need liquidity? Stop selling your position. Crypto-backed loans let you deposit Bitcoin or Ethereum as collateral, receive stablecoins against it, and keep full ownership of your crypto. No credit check, no income verification. When you repay, you get your collateral back. Institutional investors have borrowed against assets for decades. This is the same tool, now available without a $10 million minimum. Tip 4. Real estate. Without $500,000, tokenization breaks a property into digital shares on the blockchain. You can own a fraction of a commercial building in Austin or a residential portfolio in Miami at any entry point. Rent and distributions flow directly to your wallet through smart contracts. No fund manager, no 1.5% fee, no intermediary. And unlike a REIT, you have on-chain transparency into exactly what you own. Tip 5. Become your own bank. Every institution is a counterparty risk. Silicon Valley Bank, FTX. When they fail, your assets are at the mercy of their decisions. Self-custody means your private keys, your assets, your control. Hardware wallets in 2026 are mature, accessible, and secure. This isn't paranoia. This is understanding that your wealth should never be someone else's collateral. 5 tips, 5 tools, no banker's approval required. DeFi yield, stablecoin interest, crypto-backed loans, tokenized real estate, self-custody. The investors who understand these tools in 2026 are building a decade of advantage over those who don't. This isn't hype. This is a global shift in how the new money moves digitally. Comment which of these 5 tips surprised you most. I read every reply. And if you want to stay ahead of what's really happening to money and markets, subscribe. This is Agent Blockchain out.